Good morning, friends. Welcome to Finideas. Can everybody hear me? Give me a yes. On your chat box, you can write.
Yes.
Okay, great. Thank you. Thanks a lot. Fair enough. So it's like 10:05. So we are starting our session. The idea is about we are here to discuss an idea wherein we can invest in equity with safety so that we can achieve prosperity. So it's a smart wealth creation idea series. Fair enough. So just an introduction about us. We are Finideas. We are a SEBI registered investment advisor. The point is, we being an advisor, any advice that comes from us is in the purview of SEBI. The compliances of SEBI are being followed so that you get a proper guided, directed advice. Just a risk disclosure, the things that we are going to discuss, that is going to be about your investments, and investments are subject to market risk. So whatever decision you are going to take about your investment, you should consult your advisor, your investment advisor before taking any decision. Thank you. Okay. So as I told, we are a SEBI registered investment advisor. As a team, we are dealing with more than 75 members of NSE and BSE. That includes teams like Sher Khan, SMC Global, right? They are people whom we are providing software, they are providing them education, or we are providing them advice. We are the 26th company of India to get approval from NSE for its own algorithms, right? We have a specific team which develops the algorithm so that when the advice comes to you, it is properly vouched by the algorithm, it is from the algorithms and executed through algorithms, right? Okay, we have trained more than 40,000 traders across India. That includes a lot of people, a lot of investors, a lot of sessions for NSE. We have done it for SEBI. We have trained more than 300 people in SMC Global, wherein these people are trading on derivatives. So we have been training people who are providing you. I mean, you go to a broker and you discuss with the dealer. So we have been training those dealers on how to provide you an advice, right? So this is what we have been doing. Our mission is providing transparent solution to everyone for achieving financial freedom. The whole idea is about transparency and about financial freedom. We will give you ideas. We will discuss various investment methods. But the whole point is those ideas will be pretty transparent. The clients that are working with us, they are very much clear about their position, what will be happening in their account for 4 years from here, right? So that kind of clarity we tend to achieve when we advise anything to you. Our vision as a team, we are looking into manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023, right? So this is what the vision that we are working with. As a team, we are present in 5 countries: India, USA, Dubai, Saudi Arabia, and Oman. And we are present in more than 14 cities across India. These are the cities where if you are looking in for some local support, we can provide you the same. Lockdown update, post lockdown, what activities, what we have conducted more than 250 plus webinars. In these webinars, they have received more than 33,000 registrations. Not only people have registered, they have participated. I mean, more than 21,000 people have participated. Not only they have participated, they understood the strategy, they believed on that strategy, and have added 120 plus crores in this strategy that we are going to discuss. I am disclosing these numbers so that you have, I mean, we tend to believe that post corona or post anything, any disruption that happens, people who tends to deviate their way tends to get results, right? So this is what we have been doing. Okay, so now let us begin with the core part of the discussion, which is an index long-term strategy. The whole idea about the strategy is that we want to have risk on a lower side and returns on a higher side. I mean, if you will understand during the course of this strategy discussion that you realize that reducing the risk has actually increased the returns for the client, right? So this is what we are going to understand. Now, when we talk about investment, one of the most invested asset class is property, right? I mean, we discuss a lot of, we meet a lot of investors, we meet a lot of people, and we found that if somebody is worth, say, let's say 10 crores, of that 50, 60, 70% of his net worth, I mean, maybe around 6, 7 crores of his net worth is parked in his property. Something like if you count his house, you count his factories, you count his offices. So this kind of investments people do have in property. Question is, why this kind of confidence we have in property? Okay. So there are a lot many answers that we keep on receiving. One of the major answers that we receive has been like, people believe that it is a safe investment. I mean, it's something like, say, for example, somebody, say, for example, has purchased a property worth 1 crore. So what he knows is that this property may rise to 1.2 crore, or this may fall to 80 lakhs, right? That is possible, right? Because depending on the prices of the market. But what they know for sure is that this property is going to remain with us, right? It is not becoming zero. Are you getting my point? Are you getting my point? This is the first confidence that generally people have in property. Everybody, give me a yes. Is this clear? Is this clear? Like, this is one of the confidence that property gives you when you invest in property, right? Okay, great. Thank you. Thanks a lot. Right. So this is the first confidence that people have in property. Now, when they look at the second part of it, a few people have a different kind of a reason. What they say is that today maybe property market is in some slack period, right? It's not growing that one. Maybe some negative returns also there in property market. But what they know for sure is that if they hold this property for 3, 5, 7, 10 years, sooner or later they will get their prices and they will get the returns as well, right? This is the second confidence they have in property. This is what they have observed during number of years that has gone by, and this is the confidence they are carrying with them for the future as well, right? But when we go in equity market, you don't have that kind of a confidence. We have seen equities which become zero. I mean, they have been scripts which were worth 300 rupees 3 years back, and today they are not worth even 35 paisa, right? So that kind of equities we observe, right? So if we understand this, we understand that in equity market, risk is high. Okay. Similarly, you will find scripts which has multiplied by maybe 100 times, 1,000 times over course of 20, 25 years, right? So here returns as well have been pretty high. Given this, we as an advisor, we decided that we are not going to invest in individual equity, right? So then where we are going to invest in? We will invest in indexes. Am I clear? Everybody, is this clear? Right? That given high risk in equity, we don't want to invest in equity. We want to invest in index. Now, what is an index? Okay. So possibly there may be some people attending the webinar who have heard of Nifty at least, which I mean, it rises sometime by 100 point, it falls down by 200 point, something of that sort, at least minimum that has been heard about, right? Nifty. Okay, but what actually Nifty is? So Nifty is basically an average of, it's a portfolio of top 50 companies of India. It's something like today the number one company of India is Reliance. Second is TCS. Third is HDFC Bank. Like this, there are total 50 companies which are held in Nifty. I mean, I will just give you a brief about it. How do they select these 50 companies? So let's say in NSE there are 10,000 companies. Okay. So what they do is they will get the value of each company and then they will sort it by 1, 2, 3, 4, 5, 6, right? The biggest one is at the top and the lowest one is at the bottom. Okay. And from that, the top 50 companies are selected and placed it into Nifty, right? To make it more clear what happens, how does it work? What happens if, let's say, for example, there were some companies like Satyam Computers or Arcom. I mean, there may be people who have heard of it, right? So Satyam Computers, at one point in time, it was India's 40th largest company and it was there in index. Then what happened? There was some challenge, there was some fall in value, some issue in the company, and it started falling down. And as soon as it went to 51 number, it was out of the index, and 50th largest company of that point in time was taken inside the index. Am I clear? Everybody, is this clear? Give me a yes. Right? Okay. So this is how the index works. Right? It keeps on having the top 50 companies of India at every point in time. Just to make it more clear, for example, you decide to invest in Nifty today. So what you will have is in your portfolio today's top 50 companies of it. Okay. 5 years before, it was holding the top 50 companies of that particular point in time. And after 10 years also, it will be holding the top 50 companies of 2031. Am I clear, right? So if you hold Nifty today, what you know for sure is that maybe Nifty may go up, Nifty may go down. That's not the argument here. But it will always have top 50 companies of India and it will never become zero. Right? This is clear. So this is the first confidence that we have in Nifty. Right? I mean, for example, you invest in Nifty today and you also forget, and you forget us as well, right? So 20 years after also, if somebody of your family member picks up your portfolio, he will know that he is holding the top 50 company of that particular time and there is a value in it, right? So this is the first point that we understood. Now what we did, we analyzed this mathematics a bit more. What we understood that Reliance today is worth around 13 lakh crores. TCS is around 12 lakh crores. HDFC Bank is around 8 lakh crores. The total portfolio is around 117 lakh crores, right? And at that point in time, and these were the numbers of the market capitalization of index, Reliance and TCS, index was at 15,000. Okay, now it is at around 17,500. Now, why it has increased? So, how does it work? This 13 lakh crores becomes, let's say, 14 lakh crores. It increases by 1 lakh crore. So, 117 will become 118 and your 15,000 will increase. If this 13 lakh becomes 12 lakh, it reduces by 1 lakh. Your 117 becomes 116 and your 15,000 goes down. Are you clear, right? So this is how index works. Now, there is a question that we ask an investor that you need to ask yourself, that after 10 years, 15 years, whichever is the India's largest company, not necessarily it is Reliance, maybe Reliance goes out of the business after, let's say, 1 year, right? Or Patanjali become big, or some new Google comes into India. We don't know what. But whichever is the India's largest company, after 10 years, should it not be worth more than 13 lakh crores? Are you getting my point, right? What do you think? Everybody, what do you think? Give me a yes. Should it not be more than 13 lakh crores? Yes or no? Okay. Great. Right. So if that is worth more than 13 lakh crores, obviously this 117 lakh crores will be more from higher than here, and your 15,000 will be higher from 15,000. Are you getting my point? Right? So the two confidence that we had in property, one, it will never become zero, and second, sooner or later it will rise in price. The very same confidence we get in index, it will never become zero, and sooner or later it will grow in price. Right? So this is why we understood that we should be investing in index. Okay, this presentation into 3 parts. The first part of the presentation is about which investment vehicle we want to select, and that is index. Now, if you look at this number, that is index rising. So we are just presenting a number. Last 21 years, if you had invested in index at any point in place, right, any point in time, and you had held it for 3 years or more, then you would have got at least the price that you have invested in or a better price, right? So this is what the index has been performing in last 21 years. Okay, so this is what we get. Okay, so now just to understand my audience, I'm just placing you a poll. Have you done any investment in equity or mutual funds till date? So that what I understand is what level of depth I need to take in, so that all of you are able to understand, right? Okay, great. Okay, great. So I will be ending this poll in another 5 seconds. 5, 4, 3, 2, 1. Thank you. Thanks a lot for your participation. Okay, so I can see my 83% of my audience have invested some point in time in equity and mutual funds. Only 17% has not invested in equity. So don't worry, people who know equity, I believe they must be able to very much understand, very much grasp the concept that I'm saying. And those people who have not invested in equity or who are new to equity, don't worry. I will keep my presentation in a way so that you are also able to understand. Okay. Thank you. So here we move on. So now the first part of the presentation, we understood which investment vehicle we want to select. Now we know that, okay, index will rise in, let's say, 10, 15 years. Okay, that is fine. But will it rise in a straight line? No, it won't, right? It won't be rising in every day. It will keep on rising. That won't happen, right? This is equity market. So there may be fast rises and there may be sharp falls as well, right? Now we don't want these kind of sharp movements because that makes us, a bit pricky, a bit of fearful, right? So what we did to remove that fear from your mind, from your investment, we had added safety to equity. So now what we do is, let's say we invest 10,000 rupees in Nifty. Okay. So what we do is, what is the fear now? If it goes up, there's no fear, right? We are enjoying the profits. But if it goes down, we are fearful because we fear that the profit, my investment may go down in value, right? So what we do is, we immediately purchase a downside protection. So what we do is we pay around 5% per annum, around 500 rupees. So now the thing that costs people 10,000, it costs 10,500. It's something like saying you purchase a car and you purchase an insurance for the car, right? So this is what we are doing. Now, once we have purchased this insurance, this premium, we have paid this premium, what we know for sure is that now if market goes from 10,000 to 5,000 and we have invested 1 crore rupees, it will never go below 95 lakhs. Are you getting my point? Right? So this is the confidence now we have. Now, if now look at the portfolio that you are getting. If you have invested in Nifty at 10,000, now if it goes to 15,000, right? So people will make 5,000 rupees, we will make 4,500, right? But still we are happy, right? We have made some profits. If, for example, market goes from 10,000 to, let's say, 5,000, so it has fallen by 50%, we are losing just 5%, right? We still are happy. Are you getting my point? So if it goes up, we are happy. If it goes down, we are fine. But there may be a possibility that market remains same, absolutely same at, let's say, after 4 years. That's possible, right? Right? If you have some queries, you can write on chat. I will take your queries during the session as well, right? So if you want, and if there's something that you think that it will be difficult for you to understand, you can even ask as well, right? So you can write your queries on chat. Okay, great. So what we are understanding is, if market remains, let's say, if it is today 10,000, if it is 17,000, obviously, but let's say it at the same level after 4 years. Okay. So now what will happen then? We will keep on paying 500 rupees every year. So at the end of the 4 years, we will be down by 2,000 rupees, right? And we will be at a negative. So let us understand this scenario, that what will happen if market remains at the very same level after 4 years. Okay. So what I have done is I have just created a chart. Let's say in 2021, market is at 10,000. And in 2025, it is at the same level. Why I am taking 10,000? So that you will be able to understand the mathematics easily, right? Obviously, it is at 70,500 today. Okay. So market is at 10,000. It remains at the very same level after 4 years. Okay. And you have invested 1 crore rupees. Okay. Now, there are 3 years in between, 2022, 23 and 24. Okay. Now, the first premise that we are working with is that we are going to have a downside protection. Okay. So first thing that we pay, that will be 5 lakh rupees, right? But before that, what I do is I just put in some possible number, like something like, let's say in 2021, it was 10,000. It took some bullish run and reached to 12,000. Okay. Then the Teji could not sustain and it fell down to 8,000, like it fell in the last year. Okay. Then again, there was a bullish run and it went to 12,000. Okay. And then it went to 10,000. Okay. So I've taken some random numbers. It went up, it went down and sort of. Okay. Now, as we were discussing, the first premise is that we are going to pay rupees 5 lakhs as our protection money. Okay. So now you will look at it something like saying you have purchased 1 crore worth property at 10,000 rupees per square feet. Okay. And you have taken an insurance by paying a rupees 5 lakhs. Okay. So now this is your structure. Now market went up. Market went to 10,000 to 12,000. Okay. So 1 crore becomes 1.2 crores. Absolutely. Great. Right. Market goes up by 20%. Your portfolio value also increases by 20%. Okay. Now from 1.2 crore, what happens is, now in the next year, 2022, your portfolio is worth 1.2 crore. So what will you protect? 1.2 crore, right? So you will pay another 5%. So you will pay 6 lakh rupees. Okay. Now again, your agreement is 1.2 crore, my value is worth, my portfolio is worth 1.2 crore, market is at 12,000, I have paid a premium worth 6 lakh rupees. Now if market goes up, my value should increase, and if market goes down, my value should be protected. Okay. Now in 2023, market fell down from 12,000 to 8,000. Okay. So what will be your fund value in 2023? Everybody, what do you think? What will be your 1.2 crores? Write on chat, please. Everybody. Okay. Right. Great. So if market falls down, yes, your value remains protected. Okay. So your 1.2 crore remains 1.2 crores. Okay. So now again, in 2023, now index is at 8,000. Your portfolio is worth 1.2 crore, and you are again paying a premium to protect, because we don't know if market will go down in the next year, it will go up. So we pay another premium of 6 lakh rupees. Okay. Now again, your agreement is, if market goes up, my value should rise. If market goes down, my value should be protected. Okay. So now in the next year, in 2024, market moves from 8,000 to 12,000. It went up by almost 50%. Okay. So what will be a 1.2 crores? Okay. 1.2. Yogesh, you can write your query in chat if you want. Right? So we will take it up. Okay. Fair enough. So what happens is, market moves from 8,000 to 12,000. Your 1.2 crore will rise, right? Because market went up by 50%, your 1.2 crore will become 1.8 crores. Okay. So now again, what you will do, you will protect your 1.8 crore by paying another premium worth 5%. So another 9 lakh rupees is paid. Okay. Right. Now there is one query. What it says is that my 1.2 will not become 1.8, it will become 1.74 because I have paid 6 lakh rupees. You're correct. Right. What is happening is your profit is 74 lakhs. There is no doubt on that. When we are calculating the profit, we will reduce all the costs that we have paid till date. But as far as the value of your portfolio is concerned, it will be 1.8 crores. Are you getting my point? So we have incurred a cost of 6 lakh rupees and we earn a profit of 60 lakh rupees. Getting my point? Right. So this is how we are looking at it. Okay. So now your portfolio is worth 1.8 crore. Now market goes from 12,000 to 10,000. So 1.8 crore will still remain 1.8 crore, right? So now what we are looking at is that market moved from 10,000 to 10,000, but your 1 crore has become 1.8 crore. Now we take up your point. Yes, correct. 1.8 crore it's not 1.8 crore. We need to reduce this cost. So when you reduce this cost, 6 plus 6, 12 plus 5, 17 and 9, 26 lakh rupees. So your net value of your portfolio is worth 1.54. Right? Now this answers your question. Great. Thank you. Thanks a lot. Right? So now the point to understand is market moves from 10,000 to 10,000, but your 1 crore has become 1.5 crore. So the point to understand is market remains same, but still we grow. Okay. Now here I have taken my assumed number 10 to 12, 12 to 8, 8 to 12. But if you look at last 18 years actual performance of Nifty, what you will observe is that Nifty has risen by 13 times from December to December, to 2001 to 2020. It has risen by 13 times. But if somebody is invested in a strategy in a way where if market goes up, your money grows, and if market goes down, your money is protected. Okay, so then your value goes to 22 times, right? And what is more important is that if you look at Nifty, there had been periods when Nifty had fallen by 52%. I mean, something like you had your portfolio worth 1 crore, and at the end of the year, it went down to 48 lakhs. Getting my point? So this is what Nifty had been performing. But had you invested in with the protection, your max reduction in value for any given year is just 5%. So generally people say that high risk will give you high returns, but we believe this statement is not correct. High risk will tend to give you higher losses. People who are making continuous money in market are the people who have some smart calculation in their mind, right? They are doing some sort of arbitrage, some sort of system, some sort of discipline that they are following, right? So there is a smart calculation that gives you high return. And here our smart calculation is invest in equity markets, but never invest without protection. Okay. Now just to corroborate this point, Mr. Warren Buffett, out of his experience of last what 70 years in investments, he came up with two rules of his investment. Rule number one, never lose money, and rule number two, never forget rule number one. What is trying to press upon is that in equity market, generally people look at returns, but we should be technically looking at risk. If you don't lose money in market, this market will give you huge returns out of them, right? So this is what we can focus upon. Great, great, great. Now there is one more poll for you people to answer. Do you understand basic profile of call option and put option? Everybody, everybody, everybody. Great, 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 great. Okay, okay. Keep participating. Great, 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 great. Very nice, very nice. Okay. So there are a lot many people who understands it and not many people who understand. Okay, this poll will be closing in another 5 seconds. 5, 4, 3, 2, 1. Thank you. So 64% of my audience does understand call option and put option, and there are 36% people who don't know it. Don't worry. People who know it, I will keep you engaged. You will be able to understand the concept for better, very clearly. And people who don't understand it, I will keep it in such a layman words that you will be able to understand what we are trying to do using these options. Thank you. Okay, so now here comes the cake of the whole presentation, and that is the exact strategy that we do. Okay, so now let us say you decide to invest 1 crore. Now, just to make it clear, this 1 crore is just an example. Okay, in the later part of the presentation, I will let you know that you can invest with a very low amount if you want. Okay, but just to make it mathematically easy, what we do is, let's say you decide to invest 1 crore. Okay, now what we do is we distribute, we bifurcate this part into two. 30% of it, 30 lakhs goes into equity and 70 lakhs goes into 10. Okay, now that 30 lakhs that we have invested in equity, what we do is we immediately go to market and purchase indexes, purchased index ETF, right? And those ETFs comes directly in your team. So we invested 30 lakhs and those 30 lakhs are back into your pocket. Okay. Now on these 30 lakhs, what we do is we put them on collateral. Okay. And we purchased 70 lakhs worth future. Now why we did it? Because we planned with an investment of 1 crore in equity, not in debt, right? So we want a total 1 crore exposure in Nifty. Now, by purchasing 30 lakhs, you will get 30% of exposure. So we need another 70 lakhs. So when you do this, what happens is your total exposure in Nifty becomes 1 crore. Okay, so for people who are new to concept of futures and index ETFs, we'll just try to relate it to you. It's something like, say, for example, you go to purchase a property, okay, which is worth 1 crore, right? You must have made such kind of transaction wherein there is a property worth 1 crore. You invest 30 lakh rupees and 70 lakhs is being funded by the bank, right? That happens. Okay. So this kind of arrangement you have been working upon. Okay. So this is also very same thing we are doing. Now, once you do that, you are owning a property worth 1 crore. Now, if market goes up, you will make money on 1 crore. And if market goes down, you're going to lose on 1 crore. That we don't want. So what we do is we immediately purchase a downside protection, right? Which comes at around 5% per annum. So you invest another 5 lakhs. Now, this is the first cost that we are incurring. 5 lakh rupees paid as the protection. Once you pay that, two things are protected. One, your 30 lakhs invested in ETF and the 70 lakhs that we have borrowed from exchange to invest in indexes, right? So both total 1 crore is invested. Okay, protected. Now, as we understand, we have taken some funding, we have taken some borrowing. So the second cost that come into play is the interest cost. Okay. Now, when you go to the market, I'm just asking you a general question. If you go to the market and you try to borrow, say for example, you go for a personal loan or for a business loan, what kind of rate of interest you generally pay? Everybody can answer. I mean, it's like 7%, 10%, 12%, right? So there are people who end up paying 11, 12% as well, right? Given their credibility, and there are people who get it at 7, 8% as well, right? Here, okay, great. Right. So here we are getting this funding at just 5% per annum. I mean, it is lower than 0.5% monthly, right? So once you do that, what you end up with is 5% on 70 lakhs. So this is the another cost that you pay, that is 3.5 lakh rupees. So in all, we pay a total cost of 8.5 lakh rupees. Okay, and this 8.5 lakh rupees, we have got two things. One is the protection. Now, if market goes up, we are least for it, and the funding as well. Right. So now all the things are there. Now you know if market goes up, you're going to make a return on 1 crore. Now, interestingly, you had invested 1 crore rupees, and we have just used 30 lakhs to create a portfolio of 1 crore. Right. So you are left with this 70 lakhs in debt, which you can invest to generate some interest, some saving of interest for yourself, right? Let's say you invest in some government bonds, okay, and you end up generating around 7% per annum, okay. So what you get up with is you get around 5 lakh rupees interest saved every year, right? Now, once that happens, so your net cost, considering your 5 lakhs, is 3.5 lakh rupees, right? And now if you do the structure, you will see that now if market goes up, I will make money on 1 crore, and if market goes down by any chance, my max risk is just 3.5 lakh rupees, just 3.5% of your total investment. Am I clear? Everybody, give me a yes. Everybody, is this clear? Right? Okay. Great. So is this clear to you all? Okay, great. Thank you. Now, this is what we call as a relaxed fund. Okay, wherein what you do is invest full 1 crore, like you have 1 crore to invest. So you have an option that you want to invest in equity markets. One option you have is you can go to a mutual fund and invest 1 crore rupees, right? Once you invest, you don't care which scrip he purchases, when does he sell, how much cash he gives, you don't care. What you care for is what performance he gave you after 3-5 years. Okay. Here also similarly, you can compare it like something like you invested 1 crore rupees. You don't care how much is going to equity, how much is going to debt. You know the overall structure. And what you know is if market goes up, I should be getting on 1 crore. And if market goes down, I should be getting return. My max should be 3.5%. But there are a few people who understand the strategy. Now, what they say is that, okay, your 5 lakh cost to protect is pretty good, right? Because there are times when Nifty falls by 2-3% in a day. So 5% for a full year, it's very good. Okay. 3.5%, 0.5% cost, lower than 0.5% cost for borrowing, pretty good, right? So 8.5 lakh rupees is fine. But this 70 lakh rupees that you're investing at 7% per annum, that he don't like. What he says is that he already has some loan wherein he already is paying 9%, 10%, right? So practically he's paying 9% there and he's going to save 7% here. What's the point? Okay. So, or say for example, he has some investment revenue where he can invest, he can generate interest more than 9%. So as a client, if you will see, what he says that you don't invest this 70x at 7%. I will repay my loan, or I have some investment, I will invest it there. Okay. So once he does that, you will see as a client as a whole, his 70 lakhs is now generating 9% per annum. So his interest saved is 6.3 lakh rupees per annum. Okay. So his net cost reduces to 2.2 lakh rupees. Almost 30% lesser than the relaxed plan, right? So this is what he can save if you have an option when you can save 9%. Okay. Now there are people who understand this strategy even better, who likes this arbitrage. What is happening is here, if you will see, He's getting a borrowing at 5% and he's investing at 9%. So on this 70 lakhs, he's saving 4% per annum. So what he says that, can I take a higher advantage of this? I want to take a more better advantage of this. I want to increase this advantage. So can you get me more borrowing? So when he says that, what we say, yes, it is possible, provided you have some collateral to keep. See, in this case, when we are borrowing 70 lakhs, we are putting this 30 lakhs worth ETF as collateral. Then it's not a problem. But if he's saying that I want to get more funding, so then what we ask is that if you have additional stocks that you have already invested in and you can put it in as collateral, then this whole structure can be created in as low as 10 lakh rupees. Okay, so now this is what happens when somebody has 10 lakh rupees and collateral worth 30 lakhs. Okay, so what we do is we put this 30 lakh on collateral and borrow futures worth full 1 crore. Okay, so now his investment is total 1 crore in Nifty. Now if market goes up, he will make returns on 1 crore. If market goes down, he will lose on 1 crore. That we don't want. So what he does is he ends up paying another 5% for protection. So 5 lakh rupees is invested here. Okay. Now because he has borrowed full 1 crore at 5% per annum, so he need to pay 5 lakh rupees as interest. So now his cost, if you look at here, you will see his total cost per annum is 10 lakh rupees. Okay. But the advantage now he has is that he can invest this 90 lakh rupees, which he has not deployed yet for creating the whole 1 crore portfolio. That 90 lakhs can be invested in some 9% interest saving avenue. So he ends up saving 8.1 lakhs as a whole, right? So if we look at his net cost is 1.9 lakhs only, almost half of the relaxed plan. Are you getting my point? So if you are somebody who already invests a lot of money in stocks and you can spare some 10%, then you can create the whole advantage of 1 crore Nifty portfolio, right? So this is very much possible. Okay. Now let's say this is one more poll question for you, and that is, do you have any kind of loans like car loan, business loan, CC? Because if you have it, you can use this product to leverage, to take the benefit, to save the interest and take an advantage of interest arbitrage, right? So this is what you can do. Great, 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 great. So I will be ending this poll in another 5 seconds. 5, 4, 3, 2, 1. Thank you. Thanks a lot for your participation. So I can see 44% of the people do have some loan and 56% of my audience does not have a loan, right? So people who have a loan, you should definitely look for this interest arbitrage that is available. You should create investment, borrow the fund and repay your loan, right? That will give you a great advantage. People who don't have it, don't worry, right? You can still use the relaxed plan. Okay. If you have some other avenue to save interest, not a problem. If you don't have it, we can still use the relaxed plan, right? Let us say we don't have that avenue to save 9%. Okay. Then what happens? So we will invest with relaxed plan. Okay. So what we do is we just analyze that. Say for example, somebody has 1 crore rupees. Okay. He starts in 2002. Okay. This is the Nifty numbers, that the travel of Nifty from 1100 to 13,982. Had you invested in Nifty or 1 crore, this is how your value would have moved. This is the value of Nifty. This is the column where we have identified, had you paid this protection money, right? The strategy that you are working with, where if market goes up, your money grows, and if market goes down, your money is still protected, right? If this happens, so this is your NLV, this is how it will move, and these are your P&Ls. Okay. So now if you will see, your 1100 has moved to 1880. Okay. So 1 crore will give you a 71% return had you invested in pure Nifty, no protection. While had you taken this protection, your value would have reduced by, your profit would have been lesser by 3%. Why less? Right. Absolutely correct. Right. So it's about because we are paying the protection money. Okay. Next year, market went moved up by 11%. We made just 7%. Okay. So what we understand is that if market keeps on going up, our returns on in Nifty will be a bit low, right? So this is what has happened. Various years we have made some profit. In some year we have made some losses as well. Okay, but over 18 years, your 1 crore has become 22.26 crores, right? And what is more important is this. In 2007, your market was at 6100. Market fell down to 2959, fell down by 52%, right? But here our value dropped by just 3%. In 2010-11, market dropped from 6100 to 4600, a fall of 25%. Our value dropped by 3%, 3%, 1%, right? So overall, if you will see that in this particular product, in no year we took more than 4% risk, right? While the annualized return of this product had been 18.8%, right? So if you are somebody who is looking for planning for your retirement or some money that you don't want to take a big risk on, right? So I mean, you're fine with 5, 7, 10% risk and you want to generate 15, 17, 18% return, this product can very well suit you. Okay. Now these were the 18 years number. Okay, so we are presenting you with a near recent numbers. I mean, there was a client who started investment 2014. So this chart shows his journey, everyday journey of that particular client. Okay, so now if you will see, we started his investment 22nd July 2014. So we have made both of them 100, investment and index at 100, so that we can compare in terms of percentages. Okay, so when market went up, his value also went up. But this red line is the value of the strategy. This blue line is the performance of index. Okay, so now if you will see, this blue line went down from the original level as well, right? While here our value also dropped, but it was still in profit. When market went up, the values kept on going. When market fell down, it also fell, but the fell was a bit lower. Just to make it more clear, just presenting with the number as well. If you will see, in 2014 July, they started at 100. Market went to, in 2015 went to 14% plus. This product went to 20% plus. Then again, when market fell down to 90% of the original level, here also there was a drop, went to 112%, right? Again, market went up to 15% plus. This was 41% plus. Are you getting my point? Right? If you look at the recent numbers in 2020, market was at 59% plus of the original level. I mean, original level was around 8200 and market was at 12,500, so around 59% plus. While this product was 87% plus. Okay, then market fell down to 98% of the original level. It was around 7800, I believe it went to March, right? While here there was a drop, but it was still 171% only, right? Again, market recovered to its original level in November 20. This product started making new high. It was at 95%. Are you getting my point? So this is what the beauty is. When market drops, your money doesn't fall that much. But if market goes up, your money starts making money. Okay. So just to summarize the whole product, this product is a combination of equity and futures with protection. This has a calculated risk. You always know for whenever you hold the position that this is the max risk that I'm running. Right? This is an index-based strategy. Your money is always parked in indexes. Given this, the profile of this product is a low-risk profile. You can, this product has a strong past record. You can see your live account. Now, what happens if you're trading, if you're a trader, if you're already investing some options and some equities, what happens is the portfolio tends to merge out, right? We don't able to identify after 5 years, 3 years, that which product was started in this particular strategy, right? So what we do is we give you a separate live account where you can see that how this strategy is performing in your account. Okay. You can use a systematic withdrawal. We do offer systematic withdrawal plans. So if you are at the age of 60, 65, or you are planning to have a systematic withdrawal 10 years hence, you can use this product. There is no lock-in period in this product. For example, you invest today and after 2-3 days, you decide to take an exit, right? So you can take an exit. There's no lock-in. Your protection is still there, right? So you can take an exit and your money will be back in 2-3 days, whatever is the exchange T+1, T+2 timings, right? So no, there's no lock-in period. The logical period of investment is 5 to 10 years. I mean, this is an equity investment, right? So any equity investment that you are planning for, you should ideally have that this is my horizon. I don't need this money for next 5 to 10 years. You will need this money. If, say, for example, there is some contingency, you need the money, you can definitely get it back. That's why there is a no lock-in period, right? But ideal investment for this particular product is 5 to 10 years. We have a dedicated team which keeps on monitoring your portfolio and identifying opportunity if something comes in, right? We are advising everything through algorithm so that you get a timely advice and it is not dependent on some human to send you something, right? You can plan your retirement and higher education because this is the money that you don't want to take a big risk on, right? So this money can be parked in here. And the most important point, the whole product is traded in your own account, right? So you don't need to partake money from your account, right? The money is always in your control. The first control is always and always yours, right? Great. So now one more poll, the last poll possibly, and that is that while investing, you give prime focus on what? Safety or returns? What is your primary choice? Great, 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 great. Very nice, very nice. Okay, okay, okay. Great. Great, 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 great. Very nice participation. So I will be ending this poll in another 5 seconds. 5, 4, 3, 2, 1. Thank you. Thanks for your participation. I can see 73% of people who are looking for safety. People who are looking for safety, I believe you must have looked upon a lot of product, but this safety of this product, I mean, the focus of this product is actually protecting your money, right? So possibly this kind of safety you might not have seen in the markets, okay? And the people who are looking for returns with safety, if you will look at, I mean, if you're looking for 50, 80, 90, 100% return, obviously this is not the product. But if you're looking for sustainable return for next 10, 15 years, this product can very well suit you. Thank you. Great, great. Right, so now I'm just taking up few FAQs and then I will open the session for your queries. Please write your queries on chat. I will take those queries and try to answer them as well. Great. So now there are some few questions that people do have in their mind. As I told, you can plan a systematic withdrawal plan in this product. So let's say you decide to invest, you want a systematic withdrawal. Now, say for example, for 1 crore investment, you need to invest full 1 crore. Okay. So you'll get an exposure of 1 crore. And from the immediately next month, you can start getting a payout of 0.5%, 50,000 rupees if the investment is 1 crore. Okay. Now, say for example, there is somebody who says, okay, fine, you are paying me out 50,000 rupees, but will I be getting returns? So now I'm presenting you, had you taken a systematic withdrawal for last 18 years, how your portfolio would have looked like. Okay, so these are the same numbers, very same nifty investment. The investment that you made is 1 crore and the person is taking a payout of 50,000 every month, right? So how much you will redeem in 1 year? It will be 6 lakh rupees, right? 50,000 into 12. So every year is redeeming 6 lakh rupees. Okay, so he keeps on redeeming every year. So in last 18 years, he redeems 1 crore 8 lakh rupees, right? So his original investment is now 100% redeemed out and he has received another additional 8 lakh rupees. And still, if you will see, his NLV is still today 15.5 crores, right? So you got the withdrawal and you still making returns, right? Your NLV is still 15.5 crores, right? So this is the beauty of systematic withdrawal plan. You're getting protection, you're getting a withdrawal, and still your money is going beautiful. Okay. Now, as I told you, 1 crore was just an example. The minimum investment for this product is 1 lot of Nifty, right? Now, what is lot? I will just tell you. I mean, people who are new for this market, lot means, so for example, you go to purchase a flat. Okay, so flat is, let's say, 100 square feet. So you need to purchase full 100 square feet. You cannot purchase, I want just 10 square feet of this flat. You can't do that, right? So this is what is known as lots. Why it is in lot? Because you can insure the whole lot. You can insure the whole flat. You can't insure 10 square feet. Getting my point? So this is what is a terminology in equity markets, wherein we say if you are purchasing, if you want protection, if you want to purchase a future, it has to be in lots. Okay. So the lot of Nifty today is 50 shares, right? So if Nifty is running at, let's say, 16,000, so your value of Nifty, your value of lot, your exposure will be 8 lakh rupees, right? Let's say if we take a very current example, let's say market is at 17,000 or 17,500, your investment will be around 8.5 lakh rupees, right? So this is what you invest if you are going for a relaxed plan. Okay. So now what I do is I just make you clear with, if for example, you're selecting either of the plan, what will be your investment? Okay. So for example, you decide to invest in relaxed plan, your initial investment will be 100% check, right? So if for example, you decide to invest 8 lakh rupees, you need to pay 100% check. In basic plan, you just need to invest 30% of it with the member, right? You need to pay just 30% to your member. Rest is with you to park wherever you want. Okay. And in power booster, you need to invest just 10% of your total money. So 80,000 rupees just that you need to pay. So just make it the numbers clear. In relaxed plan, it is 8 lakh rupees for an exposure of 8 lakhs. In basic, it is 2.5 lakh rupees. And in power booster, you need to pay a check of just 80,000 rupees, right? But as we understand, in power booster, you will need some stocks. So in relax, there is no requirement of additional stock as collateral. In basic, there is no requirement, but in power booster, you need to have 2.5 lakh rupees stock to create a portfolio of 8 lakh rupees, right? So this is what you are required. Now we just understand, say for example, if somebody is investing in either of these plan, what will be his net cost? Okay. So for example, you are investing in a relaxed plan. So your investment is 8 lakh rupees that we understood in the last slide. Your return will be also in 8 lakhs. Your annual cost will be 30,000 rupees, right? So that is like what? 3.5% of your total exposure, right? So 30,000 rupees. You will save no additional interest because you have invested the whole 8 lakh rupees here, right? So interest saved is absolutely zero. So your net cost is still 30,000 rupees. Okay. But if you go for a basic plan, your initial investment with the member is just 2.5 lakh rupees. Okay. But your returns will be still on 8 lakh rupees, right? To give you an exposure of 8 lakh, we will borrow some money in the future, right? That you remember. Okay. So we will end up paying an annual cost of 70,000 rupees because the saving of interest is with you, right? So the remaining fund that you have not invested with the member, that is 5,60,000 rupees, you will be saving interest around 50,000 rupees. So your net cost will be 20,000 rupees. Okay. And the power booster, your initial investment is just 80,000. Your return will be on 8 lakh. So your annual cost is 80,000 rupees, but you are now saving interest on 7,20,000 rupees. So your interest saved will be 65,000 and your net cost will be just 15,000. Am I clear? Everybody. Give me a yes. Is this clear? Okay. Okay. Thank you. Thank you. The last point that you need to understand, that is the cash flow, because in equity market, the most important thing that you need to know is when and how much I have to pay. Okay. So in the relaxed plan, your initial investment is 8 lakh. In basic, it is 2,40,000. In power booster, it is 80,000. The annual cost that you are paying, here it is 30,000, here it is 70,000, and here it is 80,000. And your monthly SIP that you will pay. Why SIP? Because in basic plan, the interest is with you. The interest saved, the remaining fund is with you. So to continue this product for a perpetual period of time, you need to pay 6,000 rupees monthly so that you can continue this product full time. Now, again, this is not paying. You are just investing this money in your own account. So your investment plan will be 2.5 lakh today and 6,000 rupees monthly. If you can do this, you can create a basic plan in your investment exposure. Okay. And if you're going for a power booster, you need to go for 80,000 rupees as an investment and 7,000 rupees as your monthly SIP, right? So this is the whole cash flow that you can start with. Okay. So these are the two options that you have: initial investment plus annual cost or initial investment plus monthly cost. So you can decide to pay either way. You can decide to invest monthly or you can decide to invest the whole year at one go. Okay. Now this is for whom? This product is for people who want to move from debt trap to financial freedom, because we took an advantage of borrowing at lower price and repaying your higher cost loans, right? you can take a very calculated risk. People who want to take calculated risk, and people who can stay for more than 3 years invested in equity market, right? So this is the product for those people, and this is not for people who want to earn from intraday or short term. This is not a intraday product, right? Now, as far as plans goes, relaxed plans for people who are near to their retirement, who wants a regular income, who has a low risk appetite, right? And basic plan is for people who are young investors and they can invest regularly. Why they need to invest regularly? Because there will be an SIP every month they need to pay. And power booster is for people who has good portfolio and can invest regularly, right? These are the commercials. This is the fee that is being charged by Finideas. Rest of none of the money comes to Finideas except this fee, right? So the fee of this product is, if you decide to invest below 1 crore, it is 0.75% payable 6 monthly, right? So it's something like, for example, you decide to invest with an investment of 8 lakh rupees, you need to pay just 6,000 rupees per 6 months. So 1,000 rupees per month is the cost that you're going to pay if you decide to invest below 1 crore. If it is from 1 crore to 5 crore, it is 0.625%, and above 5 crores, it is 0.5%, which is payable 6 months. Okay, great. So now, if, for example, some people have in mind that I have equity mutual funds which I can invest in, and you have one product index long-term strategy, right? So why not to invest directly in mutual? Why to do this kind of, purchasing a protection and going here and investing in ETS and all those things? Why should I do that? So let us understand. Let us just have a small brief comparison. Okay, let's say you decide to invest 10 lakh rupees. So what will be an equity investment? What will be the charge that you will pay? 10 lakh rupees, right? In ILTS, if you go for a relaxed plan, you need to pay 10 lakhs. Okay, so the impact is same. Now, say for example, market rises by 100%. Okay, doubles. So what will be your profit? Your money will also multiply, because almost a mutual fund will tend to track your indexes, right? So they will become 20 lakhs. While here, we will become just 19.6 lakhs, 40,000 less. Why? Because we are paying a cost, but it is still similar. But if there is a fall of 50%, like you had in last year, okay, so your 10 lakh will become 5 lakh rupees, right? While here, your 10 lakhs will not go below 9.6 lakhs. So now here you can see the huge difference. You are getting similar returns, and the risk that you are running is pretty low. Okay. Now there is one more question that people ask. Okay, there is somebody who's saying, okay, fine, right? So one question that people ask is, if index is going to rise in longer run, because in the original discussion we understood that over 10, 15 years it will rise. So then why to buy a protection? Why to pay this 5% every month, every year? The point is, we understood in this particular slide that there will be periods when market will be a steep rise. There will be period, there will be deep falls, and there will be period when market will remain in a range. Okay. Even market remains in a range for 3, 4, 5 years. We understood that your 1 crore becomes 1.54 crore. And why is it rising? Had you invested just a normal mutual fund, your 10,000 will still remain 10,000, because market is still there only, right? But why is it rising? Simply because of the protection that you are paying, right? So that's the beauty of protection. You are getting returns and still your money is protected. Okay. Just to give you a vision of how this value grows, what we are paying cost for. Technically speaking, market has moved from 1100 to 13,900, right? But if somebody has invested in Nifty with protection, for him, when market grows, his money grows, right? But when market falls, his money doesn't fall. Okay. So now if you will see here, we have just made a comparison at 1100, with protection also 1100. At 1880, it is 1880, because when market is rising, your money is also rising. But here, if you will see at 6139, you are still at 6140. You haven't dropped at 2959, right? Because when market drops, your money stays. So now you can see the comparison. It's something like, when market rises, you rise. But when there's a drop, your money is constant. Again, when market rises, your money rises. But when it falls, your money is stagnant. When this happens, if this is the growth you are getting, so technically your value is not 14,000. It is 40,000 for you. And now you reduce the cost that you have paid for this protection, and you will realize that you have beaten index a big time. Okay. Great. And one more question that people have is this the right time to invest? Because this is the top of the market, right? Almost 17,340 we are standing. So is this the right time to invest? So if this is the strategy that you are considering, think if market goes up, you are going to make money, right? This is good for us anyway. If you invest in equity, invest in here, it is good for us. But if in case market goes down, your max is how much? Just 3.5%, right? So if you are comfortable taking a risk of 3.5%, this is absolutely a right time to invest. Because mind you, there have been people who are waiting since 14,000, 15,000 that there will be a dip in market and I will enter, and they're still waiting. Getting my point? So why not invest today and take a risk of 3.5%? If, for example, there is a dip, market goes to 12,000, you don't need to worry. Your max is 3.5%, right? So at 12,000, you will start rising again. Getting my point? So this, if you're ready with a risk of 3.5%, this can be a very good time to invest. Okay. Can you switch from another plan? Now, there is one question. If, say, for example, I go in for a relaxed plan, can I later go to basic plan or a power booster? Yes, you can. And there is no extra fee for that. Can NRI invest in this strategy? Yes. You have an NRO account, you can definitely invest in this strategy. Why with Finideas? It's simple. I mean, we are a RIA. We do have an online back office. We do have our algorithmic trading platform, and we have an experience of 18 years in equity markets. Friends, here I end my case. If you want any update from Finideas, you can click on this link. What will happen is this link will take you to KRA. Yes, Mahesh has shared here. You can click this link. This link will take you to this form where you can show your interest. If you have any more queries, please click on this link. Click on you are interested in the strategy, and our team will connect with you and clarify and guide you, help you to in the process of investment. Okay. Once you click that, this will be the risk profiling form wherein you just need to accept it. Why a risk profiling? What will it help you? It will ask you for a few details, your name, email ID, and simple details, right? Once you do that, it will verify your PAN number and it will ask you 26 questions. Now, why this 26 question? These questions will help you identify how much investment you should be making and in which plan, right? So this is a automized advisory where you can be guided for how much you should be taking a risk upon and which plan you should be selecting, right? So this is what you get if you fill up this form, right? Once you have filled in this question, this portal will even help you to take your investment. You can, so for example, it suggests you can take up to 20 lakhs. You want, no, I don't want to go for 20, I want to go for 8 lakhs. You can, right? And then you want to check how much cost will it be there today in the live market. So this is what it will suggest you, that if you decide for investing 8.5 lakh rupees, this is the cost annual risk that is currently coming. Okay. So this is what are the benefits of KYC. You get an access to Finideas portal. You get an invitation in our WhatsApp group. Now that's a dedicated group for our investment where you can see other people also asking you a question. So maybe some question that you have, others might have asked, and you can get an answer. And post that also you can get a personal assistance. Okay. Friends, we do have some other events lined up. On next Sunday, we will at 10 a.m. and on Thursday, 4 p.m. we have this particular presentation. If you want to attend again, if you have some queries, you can definitely come and attend. If you have some people in mind, if you have some friends whom you think they are looking for this kind of a strategy, you can send them, right? For currency hedging, for people who are into imports and export, or if you have people who are connected to import and export, they can definitely come here on Wednesday, 4 p.m. and understand how we can hedge their dollar exposure. These are a few clients who have given us some testimonials, who have experienced our services, like Ishan Bhai Varia. He says we are having transparency in service, and we have executed in his own account. As I told you, we believe in transparency and we execute in people's account. This is Dr. Kukila Desai. She says the strategy is a smart work with innovative ideas. And when market has fallen, her fund had limited fall, right? So these are golden letters. Shalini Ben Jain, she says she has growth of equity market with the safety and technology and smartness are unbeatable, right? And we tend to answer all your queries. Okay, Mrs. Varsha, why she says that now she's not worried about the market fall. Her fund is protected for all kind of worst situations. Ankit Ji Mehta is a chartered accountant. He says the LTS is making money in a most disciplined way. It's a great strategy. Niro Bhai Jogani, Lemon Consulting Vice Chairman. What he says is this strategy is a combination of index with protection, research, and back data testing is really impressive. Right? We are thankful to all of our associates, Rahulji Makani, Pritiji D'Souza. These are all our partners who keep on sending people like you, and so that they can help you invest in the right way. Great. So thanks a lot for all of them. If you have some question and answers, we will be ready to answer, right? So you can write on chat. If you want to unmute yourself and speak out, we can give you that session. You can speak up and ask the question. Okay. So this session is still live for another 5 minutes. If you have any more queries, please go ahead and ask. Thank you. Okay, there is a question from Alkeshi. What is the taxation law for NRO? Okay, as far as NRO goes, Alkeshi, it's as good as a local Indian investment. Okay, so you will be taxed according to your taxation slab, right? Just that being an NRI, if you want to invest in equity markets with protection, you need to open an NRO account, right? So it's at par at other Indian taxation accounts. Right, Alkesh? So whatever slab you're into, it will be charged accordingly. It's like marginal tax that you need to pay. I mean, your answer is clear. This is what you're asking, right, Alkesh? Is this fine? If you have more queries, we can have it like offline as well. I mean, you can connect with our team member and they can answer you more. Thank you, friends. Thanks a lot for your participation. We are and okay. There is one more question. Like backdated testing, do you have any future predicted example? Okay, Jitendra ji, how do you predict the futures? I mean, if you want, I mean, we do have a lot of simulation running wherein we have, let's say, there's a rise in market, let's say by 10-15%, and there are 3 drops over the years. If you want that kind of a back testing, we can share it with you. I mean, it will be future simulations, right? Because how do you predict markets? So future simulations can be shared with you if you want. You can fill up that form. I mean, this form, that we can share you what if scenarios. There are few scenarios that we have worked upon that you can use and understand. Right? This is what you're asking, right, Jitendraji? Otherwise, just to make it more clear, what has happened with the kind of movement that had in Nifty, it is generally the proper guide, I mean, proper prediction of what will happen in future, because these are the market that keeps on repeating 80%, 90%, 70% things keep on repeating themselves. They will be they will be in next 10-15 years. You can be very much sure of that there will be growth of around 13-14% will be next over in the equity markets. You can be almost sure of that there will be 3 dips, 2 dips in the market. Getting my point, right? How exactly it will happen, that cannot be predicted, but roughly we can judge that this is what probably the movement of the market will be. It will be very similar to what has happened in the past 20 years. It will be similar in the next 20 years. Makes sense, Jitendra ji? Thank you, Jitendra ji.
Sir, Jitendra here again.
Yes, sir, Jitendra.
This is the same question again कि अगर मैंने पोजीशन लेने के बाद मुझे जैसे प्रिडिक्ट करना है कि मुझे अभी आगे जाके अगर मार्केट ऐसा हो जाएगा, या फिर ऐसा कोई चार्ट आपके बैक ऑफिस में भी होगा कि मैंने पोजीशन लिया, बाद में अगर कुछ होता है तो मेरा रिटर्न का क्या इफेक्ट होगा?
ओके ओके, तो आप बेसिकली ये जानना चाह रहे हैं कि सिर्फ एग्जांपल भी मैंने इन्वेस्टमेंट कर दिया, ठीक है, मेरी पोजीशन आ गई है, अब उसके अंदर ये पर्टिकुलर सिनेरियो में मेरा कैसा पीएनएल मुझे दिखाई देगा, दिस इज व्हाट यू वांट टू एनालाइज, राइट राइट। तो उस तरह का एनालिसिस हमारे बैक ऑफिस में अवेलेबल है, वेयरइन यू कैन प्रेडिक्ट इन टर्म्स ऑफ कि लेट्स से मार्केट में जो पोजीशन है, इफ मार्केट गोस टू लेट्स से 14,000, what will happen to my position, what will be my P&L, if for example it goes to 20,000, what will be my P&L? If you want to analyze, this is what you analyze, right? This is what you want to
yes.
right. So that is available in the back office.
That is available in client login, no?
Yes, that is also available. See, that is available currently in our admin login, but it will be very soon be available in client login. It is into testing phase, so maybe another 1 month hence you will be having into your client login as well.
Okay. So what happened? Why this question is arise? Because we are mostly we are in top as of now. अगर मार्केट यहाँ से नीचे आ जाता है,
I understand.
तो मेरा जो इन्वेस्टमेंट है वहां पे कितना मुझे प्रेशर आ सकता है?
एकदम ठीक बात, आपका एकदम सोचना सही है और ये हमको जानना ही चाहिए। तो आपको अगर जैसे आप मान लो इन्वेस्टमेंट करते हैं, उसके बाद में भी आप जानना चाहिए मेरा एग्जैक्टली क्या रिस्क आएगा, या मतलब मैं अभी क्या पोजीशन लेके खड़ा हूं, उसमें क्या रिस्क मेरे को रन कर रहा हूं, तो यू कैन डेफिनेटली आइडेंटिफाई, राइट, इट इज अवेलेबल।
एंड वन मोर क्वेश्चन कि अगर मुझे इसमें एसआईपी की तरह, यानी कि मैंने आज 1 लॉट किया, मुझे समझो 1 करोड़ डालना है, तो मैंने आज 10 लाख का किया, दूसरे मार्केट गिरने पे 20 लाख का किया, तो उससे फायदा होगा, या एट ए टाइम में डालूंगा तो सेम थिंग होगा? क्या डिफरेंस है दोनों में?
तो डिफरेंस 3.5% का है।
ओके।
अगर आप आज समझो आपने टोटल 1 करोड़ आपके ध्यान में 1 करोड़ रुपए डालने, ठीक है, आपने क्या किया, अभी 10 लाख से चालू किया, ओके, ये सोच के कि मार्केट टूटेगा तो नया 10 लाख डाल दूंगा, और टूटेगा तो और नया 10 लाख डाल दूंगा, दिस इज द प्लान दैट यू हैव इन माइंड, राइट?
यस।
अब 2 पॉसिबिलिटी है, आज मान लो 17,500 है इंडेक्स, ओके, 1 पॉसिबिलिटी इज मार्केट 12,000 आ जाएगा, ओके, और आपके जो 10-10 लाख के जो 6 जो इन्वेस्टमेंट बाकी होने हैं वो सारे इन्वेस्टमेंट हो जाएंगे। आज यहाँ पे आपने 10 लाख किया और एवरी 500 पॉइंट्स आप नया 10 लाख का इन्वेस्टमेंट कर रहे हो, ओके, तो बाकी आपका इन्वेस्टमेंट आ जाएगा। तो जो सबसे लास्ट इन्वेस्टमेंट आपने किया होगा वो 12,000 के आसपास होगा आपका, ठीक है, राइट? अब जो आप पे आपने इन्वेस्टमेंट किया होगा, मार्केट मान लेते वापस से 17,000 घूम के नीचे गया था, वापस रिकवर हुआ, तो आपका जो 12,000 का 10 लाख है उसके ऊपर आप समझ लोगे आपको 50% प्रॉफिट हो रहा है, ओके, ठीक है। अब दूसरा एक आदमी है जैसे मैं हूं, मुझे पता ही नहीं चलता मार्केट में क्या होना है, मार्केट टूटेगा नहीं टूटेगा मुझे कुछ आइडिया, मेरे पास भी 1 करोड़ रुपए है, मैंने क्या किया, मैंने सारा यही इन्वेस्ट किया। अब पॉसिबिलिटी क्या है, मार्केट 1 करोड़ का 12,000 आया तो आपका जो 10 लाख है वो तो 10 लाख ही दिखेगा, जबकि मेरा जो 1 करोड़ रुपया है ओके, वो मुझे क्या दिखेगा, वो मेरे को 97 लाख रुपीस दिखेगा, 96.5 लाख रुपीस, ओके, राइट? अब क्या होगा, मार्केट वापस 17,000 जाएगा तो मेरा 96.5 लाख से मल्टीप्लाई होगा, आपका 1 करोड़ से मल्टीप्लाई होगा, एम आई राइट? अब आप इसको दूसरा सिनेरियो भी समझो कि पॉसिबिलिटी है आज मार्केट टॉप पे है और 20,000 जाना है, तो आज का टॉप रीच करना ही पड़ेगा, यहाँ से टूटेगा कब वो पता नहीं किसी को,
डेफिनेटली वी नेवर नो,
राइट? तो पता चला मैंने 1 करोड़ डाल दिया, तो आप तो 1 करोड़ का 12,000 पे वेट कर रहे हो, मैंने 1 करोड़ यहाँ पे डाल दिया, अब यहाँ से मेरा तो 1 करोड़ बढ़ना चालू हो गया, ओके, पॉइंट, तो पॉइंट कितना डिफरेंशिएशन कितना क्रिएट कर लिया आपने, 3.5% आपके शायद बच जाएंगे अगर आप आज इन्वेस्ट नहीं करोगे, ओके, राइट? तो इफ यू आर फाइन कि मेरे को मार्केट प्रेडिक्ट करने में दिमाग नहीं लगाना है और मेरे को 3.5% का रिस्क चलेगा, तो यू कैन वेरी वेल डिसाइड टू इन्वेस्ट टुडे, लमसम ये भी हैव टू डिसाइड, डाल दिया जो डालना है वो डाल दिया, मैं रिस्क तो 3.5% ही ना, अभी ये म्यूचुअल फंड या कोई और तरह का प्रोडक्ट होता ना तो डेफिनेटली उसमें इंपैक्ट आता, क्योंकि पैसे 50% टूट जाता अपना, नो दैट इज 3.5%, इसकी वजह से ये चल रहा है, गेटिंग माय पॉइंट,
गेटिंग, because I am one more big portfolio and I want to invest in Nifty, and this is the time that fear is coming whether market will go up or not, unpredictable is there, so whether I have to sell all the stock and put into the index, or I have to gradually do the shifting, that is my basic question,
right? So what do you think what you should do?
Now there you said that there is a risk of 3.5%,
right?
it is depends on me now. I have to lose 3.5% or not.
राइट राइट राइट, है ना. अगर आपको 3-3.5% का रिस्क चलता हो ना, मैं अगर होगा ना, मैंने जैसे मेरा ये इन्वेस्टमेंट मैंने 2016-17 में कन्वर्ट किया था. मेरा जितना भी रिलायंस, टाटा स्टील, जो कुछ भी खड़ा था, वो सब बेच के मैंने इंडेक्स में आया. मार्केट टूट जाएगा, वो तो मुझे पता नहीं कब टूटेगा, पर टूट जाएगा तो मेरा तो 3% का रिस्क है, लेकिन यहाँ से चलेगा तो मुझे ऑलमोस्ट इक्विटी रिटर्न आने वाले. मेरा पोर्टफोलियो ऐसे भी इंडेक्स के आसपास का रिटर्न जनरेट करता है. अदरवाइज भी अगर आपके पास 10 से ज्यादा का बड़ा पोर्टफोलियो है तो इंडेक्स के आसपास ही आपका रिटर्न आता है. तो अगर वही आने वाला है तो रिस्क क्यों? व्हाट्स द पॉइंट? सो दिस इज व्हाट यू कैन आल्सो थिंक ऑफ.
Sure. Thank you.
थैंक यू. Okay. Alkesh ji ka question is, your this index strategy 100% protected or partially protected against downfall? Okay. Alkesh ji, what do you think? 100% protection लिया अपन ने कि partial लिया? Okay. बहुत सिंपल सा पॉइंट है. अपना जो प्रोटेक्शन है वो 100% का प्रोटेक्शन है. अपन एक भी रुपया डाउन साइड प्रोटेक्शन के खुला नहीं छोड़ते हैं. बताइए, वैसा है कि मैं गाड़ी खरीदता हूं तो मैं थर्ड पार्टी इंश्योरेंस नहीं लेता हूं कि किसी को कुछ होगा तो लूंगा. इट इज 100% फुल इंश्योरेंस. कुछ भी होवे मेरा पैसा टूटना नहीं चाहिए. राइट. तो अगर आपने 1 करोड़ का इन्वेस्टमेंट किया है तो आपका प्रोटेक्शन भी पूरे 1 करोड़ रुपए का ही होगा. एम आई क्लियर अल्केश जी? This is your question, right? Okay, thank you. Thanks a lot. Thank you, friends. Thanks a lot for attending so patiently for this much time. Right? If you have any more queries, we will be very happy to answer. You can click on this bit. Okay, there is one last. Can we follow any profit booking strategy? Okay, I will just answer this question, Alkesh ji, so that everybody else can also understand. See, ये जो strategy है ना, Alkesh ji, this is automatically having a profit booking system. How I will tell you. See, when market goes, अपन एक example देखा था, market move from 10,000 to 12,000. Okay, so 1 crore became 1.2 crore. Right now, what is the objective of profit booking? Profit booking objective है भाई 20 लाख का profit हो रहा है. Let me take that money out of the market so that if there is a fall in market, that 20 lakh still remains with me. Am I right? That's the objective of profit booking. Now, what we are doing is, when your value grows to 1.2 crores, we protect the whole 1.2 crore. So even if market now goes down, your value is still 1.2 crore. Are you getting my point? जैसे अपना वाले केस में 12,000 से 8,000 चला गया था मार्केट. It fell from 12,000 to 8,000. Your profit of 10 to 12k was still intact. Are you getting my point? Not only your principal is intact, your profit is automatically locked when market goes up. Right? So you don't need to technically follow profit booking strategy. You just need to protect it wherever you want. Right? You're clear? Thank you. Thanks a lot, Alkesh. Great. So I'm just sharing you this link again. This is the link. You can click. If you have any more queries, please follow this link. Give us a feedback. You are interested in the strategy. Our team will connect with you and answer. Okay. If you have come up through some associate or some referral, you can even ask them to connect with us. We will be very happy to answer. Thank you. Thanks a lot. Is this under PMS? No, Alkesh. Okay. Now again, this is an interesting question. Is this a PMS? Now what happens in a PMS? You give the money to the PMS manager. While this, in this case, your money is never going out of your pocket. These are managed portfolios. The money is always in your own account. Am I clear, Alkesh? So this is not PMS. These are advised portfolios. Thank you. Thanks a lot. Thank you, everybody. We are closing the session now. For more queries, you can connect. Thank you.